Hi, this is Sally's Book Talk, bringing you great books every day. Today we'll be exploring the book, I, The Wave of Technology. I, by Dr. Jeff Wu. Dr. Jeff earned degrees from Tsinghua University and Johns Hopkins University, became an early Google engineer designing CJK cert algorithms, and later transitioned into Silicon Valley venture capital. In I, The Wave of Technology, Dr. Jeff, meticulously analyzes the rise and fall of tech giants like AT&T, IBM, Intel, Microsoft, and Oracle. These histories reveal common patterns in how tech empires emerge, dominate, and eventually decline. These patterns offer valuable insights for American entrepreneurs and innovators. Let's explore 6 key patterns from the book. First pattern, rising through technological revolutions. Dr. Jeff compares technological revolutions to ocean waves. Over the past century, certain companies rode these waves to success. Once positioned at the wave's peak, companies could coast forward effortlessly for a decade or more. During these periods, they embodied technological progress and cutting-edge innovation. When new waves emerge, the landscape reshuffles, dominant players collapse, legacy brands fade, and agile startups rise through innovation. Take T-Wode's 3G dominance. They commercialized military CDMA technology, despite skepticism, securing critical patents. This created the Qualcomm tax that global manufacturers had to pay during the 3G era. Another example is China's chip designer, Spreadtrum. By early 2009, Spreadtrum neared collapse with dwindling clients and stock below $1. They reversed fortunes by pioneering China's 3G standard with 40 nanometers multimode chips, achieving 200% revenue growth by 2010. Take IBM after WWII. They rode the computer revolution wave, transforming from machinery to computing. IBM not only hired computer pioneer John von Neumann as consultant, but invested 9% of revenue in computing. By the 1960s, IBM had invested $5 billion in computer R&D, reaping massive revenue growth. Within 5 years, revenue tripled, establishing IBM as the computing superpower. Even in crowded markets, seizing tech opportunities enables breakthroughs. Oracle's story perfectly illustrates this principle. Oracle rose between IBM and Microsoft by capitalizing on database innovation. Today, Oracle reigns as the world's second-largest software company and database leader. Oracle's database market share exceeds the combined total of IBM, Microsoft, and SAP. In the 1960s, IBM controlled 2/3 of global computing, with market cap reaching 3% of US GDP. Anticipating antitrust action, IBM voluntarily opened its software market. Oracle's founder Larry Ellison seized this chance to enter IBM's lucrative database software domain. However, Oracle initially only gained database access without threatening IBM's dominance. In 1970, IBM scientist Edgar Codd invented revolutionary relational database theory. Despite Codd's advocacy, conservative IBM clung to outdated technologies. Oracle privatized this innovation, developing the first commercial relational database system R within 2 years, securing U.S. military contracts. Meanwhile, IBM made a fatal error, maintaining hardware swabian, bundling post-market opening. Oracle revolutionized the industry by partnering with DEC to separate hardware, software sales. This gained Oracle support from most hardware manufacturers except IBM. As the saying goes, many hands make light work. With hardware partners' support, Oracle achieved unprecedented success with 15x revenue growth in 5 years. Oracle's database dominance stemmed from seizing database innovation opportunities. Beyond Quillode, IBM, and Oracle, companies like Nokia, Cisco, Google, and Apple also rose through technological breakthroughs. These companies shared a common trait: heavy investment in promising technologies and rapid commercialization. The second Silicon Valley pattern: leveraging industry giants for growth. While technological innovation creates industry leaders, as shown in the first pattern, tech competition remains brutal. Technology alone doesn't guarantee success. Some Silicon Valley cities survived fierce competition by aligning with giants before becoming industry leaders themselves. Take Intel, the world's largest CPU manufacturer supplying most computer server processors. In 2016, Intel reported $59.4 billion revenue with $10.3 billion net profit. Though technologically unchallenged today, Intel's early processors lag behind competitors. 1980s. Intel processors underperformed 1970s IBM, DEC products. This forced Intel to survive in low-end markets ignored by giants. Intel's turnaround strategy involved leveraging established players. Intel's main rival Motorola had been supplying military communication gear since WWII. By the 1960s, Motorola led in communications and integrated circuits. In 16-bit processors, Motorola's 68000 outperformed Intel's 8086 by 5x, released 2 years earlier. In the 32-bit processor era, Motorola's 68020 completely outperformed Intel's 80386. With HP, Sun, and Apple using Motorola CBS, Intel sought partnerships to bridge the technological gap. Intel partnered with IBM during its 1980s PC development, riding IBM's success to sell 100,000 units in first year. Through IBM's dominance, Intel overcame technical inferiority to defeat Motorola. While Microsoft now monopolizes OS market, both IBM and Apple had similar opportunities. In 1981, Apple co-founder Steve Jobs invited Bill Gates for collaboration talks. Jobs' Macintosh demo unintentionally revealed revolutionary GUI technology to Gates. The Mac's graphical OS dwarfed Microsoft's text-based DOS system. Microsoft's products appeared primitive compared to this breakthrough. How should Gates respond to this technological gap? With technical parity impossible short-term, Gates focused on business strategy. Gates strategically acquiesced to Jobs' terms while developing Mac software. Microsoft even allowed minor contractual concessions to Apple. This collaboration provided critical insights into Apple's technology. These learnings proved invaluable for developing Windows OS. Following Intel's playbook, Microsoft sought powerful allies, notably IBM, the OS Two partnership with IBM became Microsoft's strategic move. When peace first emerged, IBM chose Microsoft's OS to speed up development. As PC business grew, IBM tried to reclaim OS control from Microsoft. Despite IBM's hidden agenda, Gates continued collaboration. Gates knew catching Apple was impossible. Partnering with IBM bought time to counter Mac's impact. The IBM alliance constrained Apple while building Microsoft's technical capabilities. Microsoft quietly studied Apple and recruited experts, including Xerox's original GUI developers. Xerox actually pioneered the GUI we use daily. Apple's GUI was adapted from Xerox's innovations. Jobs' adoption of Xerox tech is detailed in his biography. We'll skip specifics here. After hiring top talent, Microsoft began developing Windows. With Windows 3.0 in 1990, Microsoft moved beyond primitive DOS to compete with Apple, IBM's advanced systems. Microsoft's half-hearted OS 2 promotion backfired as Windows 3.0 over 3.1 outsold it within months. Microsoft decisively defeated both IBM and Apple in the OS market. Windows 3.0 delivered the knockout blow under Gates' leadership. Microsoft's decade-long strategy of leveraging giants exemplifies our second pattern. Pattern 3. Form alliances to achieve dominance. Strategic alliances isolate competitors and systematically eliminate market share through collective power. Forming alliances enriches industry ecosystems and creates pricing advantages. Monopolistic models isolate themselves, multiplying enemies until defeated by coalitions. The Wintel Alliance exemplifies successful strategic partnership. Microsoft and Intel's timely alliance cemented their market dominance. Both companies needed alliance. Microsoft to cement dominance, Intel to survive competition. Gates' decade-long struggle finally overthrew IBM and Apple. Microsoft urgently needed to consolidate its hard-won OS monopoly. Intel faced more complex challenges in this partnership. Dynamic technological inferiority haunted Intel's early development stages. RISC processors gained academic industry favor in 80s, 90s. As Motorola declined, new RISC rivals surrounded Intel. IBM's power, DEC's Alpha, Sun's SASP RC, all RISC challengers emerged. Intel's CISC chips lagged behind in performance again. Exponential R&D costs made processor development financially perilous. Soaring R&D costs threatened survival without stable market returns. Intel needed market stability and time to outlast competitors. Intel's survival strategy involved two key approaches. Intel's strategy: improve CISC efficiency while adopting RISC advantages. Forming Wintel alliance with Microsoft and expanding 8.6 partnerships. Intel initiated horizontal integration through 8.6 compatible OEM partnerships. This formed a Calamity ecosystem. Intel developed GPUs. Microsoft created OS. Tech-keen firms made chipsets, motherboards. OEMs built complete systems. through alliances. Intel consolidated markets while eroding competitors' positions. RISC processor makers like IBM, DEC, HP Sun, and SGI fragmented their own market through internal competition. Result: no single dominant player emerged. Companies like IBM and Sun's vertical integration kept system costs high. Higher prices meant fewer buyers. Low sales volume prevented cost reductions, creating a death spiral for RISC processors. Market shrinkage doomed RISC development funding and relevance. Intel and Microsoft ultimately achieved monopoly through superior strategy. Force pattern: trading profits for market share. While high margins are desirable, market share forms corporate foundation. First secure share, then pursue profits. Lost market share renders high margins meaningless. Technologically inferior companies often slash prices to preserve market presence. When Apple challenged Microsoft's DOS, Gates priced copies at $5 each. This anti-piracy pricing aimed to maintain market share while buying development time. Had Apple dominated, Windows would have been obsolete at launch. New entrants can breach monopolies through profit-sharing strategies. ARM's rise challenged Intel's chip monopoly through strategic partnerships. To maximize profits, Intel tightened 8.6 patent licensing. They sued Transmata into oblivion and revoked VI, a technology's 8.6 license, collapsing BIA's Kidiko business. This monopolistic approach bred resentment across the chip industry. ARM cleverly offered affordable architecture licenses instead of chips. This profit-sharing model attracted numerous partners. Companies like TISTM, WeGold, Apple, MediaTek, Huawei, ZTE Marvell, and Spreadtrum joined ARM's ecosystem. ARM became Intel's equal through smartphone boom and collective innovation. CIS pattern: focus on core competencies for longevity. After achieving dominance, companies shift from expansion to preservation. Maintaining success proves harder than achieving it. Many giants decline post-peak. Over-diversification creates technical mediocrity. Motorola exemplifies failed diversification, creating multiple rivals. Motorola competed with Intel in CPUs, TI in disk space, Ericsson, Nokia in telecom. Defeated in each sector, Motorola ultimately collapsed. IBM mastered focus, maintaining core strengths unlike Motorola. Though perceived as outdated mainframe maker, IBM strategically reinvented itself. But IBM's story isn't that simple. Though IBM sold PC server divisions to Lenai, it remains the world's largest services company, third largest software database provider. IBM Research maintains industrial leadership with record patent filings. IBM's longevity stems from focusing on core competencies and divesting low-margin businesses. Despite 60's 70's glory, IBM lagged in 80's computing revolution. Though PC pioneers, IBM lost to Microsoft, Intel, who eroded its mainframe dominance. IBM suffered historic losses during this crisis period.
Some doubted IBM's survival during this dark chapter.
Lou Gerstner's core-focused strategy rescued IBM as CEO. Consumer markets exposed IBM's pricing weaknesses against competitors. Enterprise clients, government, military, banking valued security over cost. IBM's strength. Gerstner refocused on enterprise, cutting non-core units, layoffs, asset sales, radical streamlining, improved efficiency and profitability. IBM doubled down on integrated hardware, software service solutions. This created dependency among government banking clients through full-stack solutions. Though Gerstner's cuts caused short-term pains, his strategy proved effective. After streamlining, IBM gradually recovered. IBM stock surged 10x during Gerstner's decade-long leadership. Gerstner's philosophy continued, shaping IBM post-departure. Today, IBM remains focused on core domains, avoiding unfamiliar ventures. Low-margin divisions like hard drives, PCs, and x86 servers were sold to Leland Hitachi. While missing internet opportunities, IBM gained crisis resilience. During 2007-2009 crisis, Sun Yahoo collapsed, while IBM remained stable. Focusing on high-margin cores allowed IBM century-long stability through economic storms. 6 pattern. Short-term capital interests harm long-term growth. Founders lose control as investors gain power. Some even get ousted like Jobs from Apple. Capital seeks quick stock gains, regardless of long-term consequences. Executives prioritize stock-linked bonuses over sustainable growth. This alignment creates destructive short-termism.
Corporate greed can destroy even century-old tech giants.
AT&T serves as the prime example. History books show AT&T founder Alexander Graham Bell invented the telephone. From inception, AT&T dominated the industry as the market leader. For over a century, AT&T thrived, reaching $70 billion revenue by 1994.
But the decline began in 1995 due to capital greed and poor decisions. The root cause: short-sighted profit chasing by stakeholders.
In 1995, executives proposed splitting equipment manufacturing from telecom services. AT&T's telecom services competed with MCI and Sprint, who refused to buy AT&T equipment. Spinning off manufacturing would allow selling to these former competitors. Wall Street anticipated stock surges from the split. Executives and stockholding employees aligned with investor interests.
Rational voices were drowned out by institutional investors' control. The short-sighted spin-off commenced like killing the golden goose.
Lucent Technologies emerged from AT&T's manufacturing division. Morgan Stanley underwrote Lucent's 1996 IPO at $18 billion valuation. As predicted, Lucent secured MCI, Sprint contracts with soaring stock prices. Shares skyrocketed 13x over 4 years, peaking at $244 billion market cap.
Market realities prevented sustaining Wall Street's growth expectations. Lucent took dangerous financial gambles to maintain appearances. They loaned money to small firms to buy Lucent equipment artificially.
This accounting trick boosted reported revenue through uncollected receivables.
In 2000, the dot-com bubble burst. Companies borrowing to buy Lucent equipment collapsed, turning receivables into massive losses. But one greedy move wasn't enough to destroy Lucent and AT&T.
The second wave of greed soon followed. Around 2000, Wall Street found faster profits through IPOs and spin-offs rather than building companies. AT&T and Lucent began spinning off prime assets for IPOs.
From 2001, Lucent's workforce shrunk from 165,000 to 30,000 through layoffs and asset sales, with stock plunging from $100 to 55 cents.
While AT&T Lucent crumbled, Wall Street bankers and executives filled their pockets.
Lucent was acquired by France's Alcatel, moving Bell Labs HQ to France, while SBC Communications swallowed AT&T.
The same executive who sank Lucent later nearly destroyed HP through similar tactics.
Yahoo and Overstock also fell victim to capital greed.
Why don't tech companies resist Wall Street's short-term demands? Overstock's stock crash reveals why. Overstock's CEO Patrick Byrne was rare in confronting Wall Street. After its 2003 IPO, Overstock initially thrived.
But missing Wall Street's quarterly estimates by mere cents triggered rating downgrades in 2005. Overstock's stock halved within days, nearly collapsing the company. With such precedents, U.S. tech firms dare not prioritize long-term growth over short-term gains.
This concludes our exploration of tech giants' rise and fall patterns from The Wave of Technology 1. Let's recap these fundamental principles. 1. Ride technological revolutions. Invest heavily in promising innovations and accelerate commercialization during new tech waves. 2. Leverage industry giants. Strategic partnerships help startups survive competitive storms and mature into new leaders. 3. Build dominant alliances. Collective power isolates competitors and systematically eliminates market share. 4. Prioritize market share. Maintain foothold through pricing strategies or profit-sharing partnerships. 5. Focus on core competencies. Maintain leadership through specialization while divesting non-core operations.
6. Resist short-termism. Capital's profit-chasing and executive greed can destroy century-old enterprises.
As China advances in AI, semiconductors, aerospace, and advanced manufacturing, we'll see Chinese equivalents of Intel, ASML, and Boeing emerge. Through innovation and strategic execution, Chinese enterprises can ride these technological waves to global leadership. This concludes our discussion of The Wave of Technology. Find key takeaways below. Join us tomorrow.